Welcome to our Market and Economic Update webinar. We will begin the webinar in a few short moments. Hi, and welcome to the Market and Economic Update webinar at Patelco. We will begin the webinar in a few short moments. Good evening and welcome. We are going to start the webinar now. Welcome to our Market and Economic webinar. We will begin the webinar right now, and I am Carolyn Wilson, Director of Investments for Patelco Financial Solutions. First things first, I want to show this important disclosure, or what we sometimes call the not may. In short, investment products are not FDIC or NCUA insured. They are not guaranteed by the credit union, and they may lose value. Now let's go over a few housekeeping items. All participants will be in listen-only mode. There will be a lot of charts and graphs tonight, but we want you to sit back and relax. And that's why this webinar is being recorded. We will be sending you the replay in about a day or two. Our main speaker will present for about 20 minutes, after which we will begin the Q&A session. You're encouraged to type in your questions in the Q&A section as you think of them and at any time during the presentation. And please, we appreciate if you use the Q&A instead of the chat, just so we can keep an eye on your important questions. At the end of the presentation, I will tell you about a promotion where you can receive a $100 Amazon e-card for investing with one of our financial advisors. Our partner for tonight's webinar is AllianceBernstein. You will hear about the economy, the financial markets, interest rates, inflation, and also ways to help mitigate risk. My friend and contact at AllianceBernstein, Tony Kaforos, is a certified investment management analyst. Tony is helping with the Q&A, and he's also flipping the slides tonight. He has brought us a top-notch speaker for this webinar. Our speaker, Walt Seiske, is a senior investment strategist at AllianceBernstein. And in the past, Walt has also been a portfolio manager and chief investment officer. Officially, Walt holds a professional designation of a certified financial analyst, or CFA. Walt has over 3 decades of experience in the industry. He's the proud father of not only 2 daughters, but welcomed a new granddaughter who is just 9 months old. So at this time, I would like to turn it over to Walt to start the presentation.
Thank you so much, Carolyn. Just checking if you can hear me okay from your side.
Yes, it's great.
Excellent. Awesome. The technology is working so far. We'll take it. It's my pleasure to join you all, and thank you for your time this evening. Carolyn, we appreciate, I know I speak for Tony, we appreciate the opportunity to address yourself as well as your members. And as Carolyn said, there are a lot of different graphics, etc. But I'm going to just do my best just to keep things simple and keep things tight because there is a lot of things that are going on. But really, when you get to it in the final, there's just some simple, timeless things to keep in mind when you're investing or navigating the market landscape, because there's always going to be twists and turns. That I can guarantee you in the capital markets, and more recently, certainly in 2022, we saw a lot of that. Which maybe if we could go to the next slide, I'm a believer that living through something and seeing it visually, a picture can tell 1,000 words. Now this is just some recent experience. So let me just tell you what we're looking at. If you look on the far left-hand side, we're breaking down the stock and bond markets into groups or categories. So the top box is equities. Just think of that of different stock markets. Credit, that is things such as corporate bonds. So if it's bonds issued by someone like Coca-Cola as an example, or some high yield bonds or companies that aren't investment grade credit, what we like to call those, that's a category. We show emerging market bonds and global corporate bonds. If it's, but someone like Sony Corporation or Toyota, right? If they're issuing debt into the market, that's what that's means by global corporate bonds, high yield bonds, et cetera. Below that, that third box on the far left, you see government bonds. That could be anything from treasury notes here in the United States, tax-free municipal bonds, and we list areas such as Japan and the Euro area in terms of what their government bond yields did. And the last but not least is alternatives, as the name implies. Those are investments that tend to zig when things such as stocks and bonds, more traditional investments, zag. So they typically offer an element of diversification beyond just stocks and bonds. So again, if you're looking at this, if you're reading it like a book from left to right, we have the different groups from equities to credit to government bonds to alternatives. And the first column with the bars, that shows how they performed in the first quarter and at the end of March. And it was certainly a welcome departure to see that those bars are on the right or the positive side of the ledger across the board, as I mentioned. If you look at the US stock market, a lot of people know or familiar with the Standard & Poor's 500 index. That's a popular benchmark. That benchmark, the first bar you see, the stock market by that measure was up 7.5%. Interestingly, if you look at that third line, the EFI index, that's an international stock market index. Those also were positive. In fact, they outperformed the US markets. Those were up 8.5%. Then if we look at the different areas of credit, if it's high yield bonds or if it's emerging market or global corporate bonds, all had positive returns. Same for municipal bonds and government bonds of the US and other parts of the country. And even alternatives, they got into the mix. They registered a positive return. Now, that is quite a contrast if you move in the middle section. That was last year. That was 2022. And as you could see, there weren't many places that one could hide. We were in a period of time where interest rates were going higher because the Federal Reserve was raising interest rates to try to tame inflation. That proved anything but temporary at the time, what a lot of people had thought it was going to be. Some of that and a lot of it is just the knock-on effects that we went through the COVID pandemic and the Federal Reserve being more accommodative or taking interest rates to zero. But nonetheless, that unleashed the inflation monster, if you will, and the stock and bond markets don't like that. And that the proof is in the pudding that you see there. So we have some longer term data, but I think really the two things to focus on are those first two columns, which is a nice, refreshing departure. And while we still expect more volatility for the rest of the year, we think we're on firmer ground than certainly what we had to deal with last year. But if we go to the next slide, it's really interesting to see there was a lot going on below the surface. Yes, we had positive rates of returns, but I like to call this chart the tale of three cities. So you take the month of January. So that blue line, what that's showing, again, is the Standard & Poor's 500 index, or just a good measure of how the stock market does. And you can see in the month of January, that first, on the far left, that first section, we were up 6.2%. And the market was going higher on the expectation that, hey, listen, we're starting to see some, we're not where we need to be, but we're seeing some improvement in inflation. So maybe the Federal Reserve stops raising interest rates. So the markets love that. They were coming from a lower base because they really took a beating last year, and the markets took off. And then we came to early February 2nd to be exact. And we had what we'll call the not so fast moment. In other words, if the markets rallied on the the expectation that maybe they start cutting interest rates, we had a strong jobs report. We had an inflation report that was still above expectations. There's a lot of headlines. I'm not going to call them all in the interest of time, but there was a lot going on. But in February, the markets got signals that, hey, the Fed's job's not done yet. In other words, they're not going to be cutting rates anytime soon. And then the stock market sold off in late February. Not to be outdone, when you go to the third panel on this, if that weren't enough, the third panel you go to, the markets had a bit of a recovery from the February lows. And then we had the news with Silicon Valley Bank. We had Signature Bank. We had just concerns across the banking complex that shook the market up. The market sold off, and then there were some signals that there was a lot of fears that was going to spread. We haven't seen that, thankfully. I'm not saying that we're completely out of the woods, but we haven't seen it spread like a 2008 scenario. So consequently, the markets exhaled a little bit, and then they rallied to close the market. So, or close out the quarter. So yeah, a whole lot going on. And we're beyond just the stock market. We want to talk about some of the other things, just what's happening in the economy, and specifically what's been going on in the banking industry, because I mentioned that rattled the markets in early March, but we've seen a bit of a recovery since then. So let's talk a little bit about what's occurred in certain segments of the banking industry. Again, let's go from left to right here. So as a result of the COVID crisis, banks did see a lot of inflows in a form of deposits. You saw money go into a lot of banks' accounts because the markets were getting shook up because of the pandemic. There was a market sell-off. And I will say the consumers, even before the pandemic hit, were in very healthy financial shape. Then we had a lot of stimulus money. Granted, there were some people who needed it, but there was so much of it out there. Some people you could argue, maybe they didn't need it as much as others, but nonetheless, there was a lot of money in the system. So we saw deposit growth really, really ratchet higher. Loan growth bounced off of its lows from the COVID. That's the bottom line that you see on the far left. But then what we started to see happen when the Federal Reserve started to raise interest rates higher, people recognized that, hey, wait a second, cash as actually an asset class again. In other words, I could buy treasury bills, or I could go into different money market funds and actually finally get a yield, as opposed to some zero account. You have 0% interest on a checking account or a savings account. I have alternatives now because short-term interest rates are higher. So what you see in the middle is those bank deposits started to trail off from some of their very, very high levels coming out of the pandemic. But as interest rates picked up, you started to see deposits shy away from your traditional banking accounts, especially some of the smaller banks. And then if you look on the far right, they've been going to some of these other areas like money market funds that are now paying you an attractive rate of interest. Now we look at levels, and it's north of $5 trillion in money market funds. People have just said, capital money is always going to go where it's going to get the best return. It's like electricity. It takes the path of least resistance. Money is ultimately going to flow where, hey, where am I going to get paid? Where am I going to get compensated to go? And that's some of the dynamics that we saw there. But the reality is that's all well and good. But inflation is still something that we're dealing with, although we have seen some improvement. And that's what these different charts are showing. I would just really say, let's focus on the one on the far left. They're all telling the same story. You see that line is starting to roll over. That's just showing the rate of inflation. And at its peak, inflation was close to 9%. That's the far left line, or the blue line that you see on the far left. And you can see now it's the year-over-year change in inflation is running closer to 5 or 6%. And that's fine, but it's still below the Federal Reserve's target of 2%. And we think that ultimately that they get there, but it's going to take some time for that to happen. Because if we look at other areas of inflation, if we go to the next slide, what we've seen happen is that there's some parts of inflation that are still staying sticky, as we like to say. They're not going away. So the first two in particular, transportation services, that line is still high, right? You see that the price for things like rental cars, or car repairs, or even if you try to go buy a new car prices are high, right? So that's something that we see that this is not going away anytime soon. And the Fed wants to see more improvement in a category like that. Another area that they want to see a category improvement in is recreation services, whether that's cable TV bills or concert tickets. Right now that the worst of the pandemic is hopefully behind us for good, people are getting out. Most people just aren't designed to just shelter in place for their whole life. They want to get out. They want to travel. So we've seen hotels, hotel prices, airline tickets, all that has gone higher. For those of you who've been traveling, you're seeing it. So the Fed wants to see some improvement of that. Food away from home. Many of us are going to restaurants. I happen to be in Chicago right now, having client meetings. I was at a restaurant earlier this evening, wall to wall, packed, filled with people. That's great to see. But the Fed is like, that's good, but we want this to kind of calm down a bit. Because if it doesn't calm down, this price increase that we're seeing, or the prices that people are paying for goods and services, it's not going to get any better. Our view is that we think that does improve. Again, it's been stubborn, but we do see inflation moderating to closer to their 2% target as we head into late next year. But these categories, it takes some time for that to happen. So why don't we pivot to the next slide? Okay, so we know inflation's a challenge. The markets have been rocky, they've been volatile, but they've been on a better footing this year. So where are we finding opportunities? Where are we finding opportunities that excite us, that give us that we think is going to continue to give us good return opportunities? And if you look on the left-hand side, we're showing different areas of the stock market especially from a growth investment perspective that we're very excited to look into. So the first one is life science tools and services. That's a mouthful, but that's effectively companies that make the tools and diagnostic equipment that sell into pharmaceutical or biotechnology companies as they do drug discovery. So, trying to predict what drug is going to make it through FDA approval, the odds of that are very low. In fact, it's less than 1 in 5 new drug applications make it through all the clinical trials and get FDA approval. So rather than trying to make a bet where the odds aren't in your favor, we would rather buy some companies that sell into all the pharmaceutical companies. There's a company that we own in one of our portfolios. It's called Danaher. They sell diagnostic equipment that allows pharmaceutical biotech companies to do research into different compounds, be it for a vaccine, a biologic, or a pharmaceutical. And we see that the earnings growth there over the next year is going to be close to 12%. Year to date, those stocks are only up 1%. So we think there's a real opportunity there. Another one that you see in the middle is application software. That could be anyone from like Adobe or a Microsoft. There's still a high need for software and software services, whether it's just a traditional Windows operating system, if it's an enterprise software, if it's software for artificial intelligence, you name it. Those stocks have done better. They're up about 23%. That's what that blue bar is showing. But their earnings growth is expected to grow about 19%. So we still think there's gas in the tank there. The last one is the semiconductors. The computer chips that go from anything to an electronic vehicle, to a home appliance, to computer data centers. Those stocks have rebounded strongly. They're up about 40% this year, but we still think there's opportunity because the earnings growth is going to be roughly 37%. So despite the volatility, there's always an opportunity for things for us to look at to get us excited where we think that there's still upside appreciation. If we go to the next slide, that's in the growth category of stocks, companies that typically grow faster. Now, value companies tend to be more established. So if I'm going to draw a comparison, if we talk about retailers as an example, a growth type of retailer, someone like Etsy, they're fairly new, they're growing really quick. It's a new concept. Where somebody like a Target or a Walmart, they're more established. They're still good companies, but they're not growing at the same rate of growth, but a healthy growth nonetheless. But within that category of value, some of the industries that you see on the left, if it's investment banking and brokerage, there's going to be a lot of financial advice that's going to be needed to given, both at the individual investor level, as well as advising on mergers and acquisitions. And we expect earnings growth there to be about 13%. Property and casualty insurance companies, earnings growth of about 19%. And we talked a little bit about this, but specialty retail, that could be anyone from Tapestry, that's the company that owns Coach and Kate Spade, some of those brands, to beauty supply companies like Sally Beauty. That's what we say specialty retail. It's those niche type companies that are either on the high end or your bare essentials that people are still going to buy beauty supplies, even if the economy slows down. Those stocks are only up 7%, but their earnings growth is close to 8%. So I wanted to just leave the group with some ideas and some thoughts what we're excited about in the equity markets. And if we go to the next slide, it's not just confined to U.S. stocks. International stocks is another area that we like. Most of the world's economies reopened, China's reopened, and now we're in this phase where the U.S. dollar has become a bit weaker. If you're a U.S. based investor, that's a good thing. if you're investing in overseas companies, because those companies' profits are at a stronger currency, and when it translates back to the US dollar, that means a better return for US investors if you're invested in international equities. And the dollar, you can see on the left-hand side, has come off of its peak. And if you look on the slide, on the display that's on the right-hand side, we show the S&P 500 in blue, and we show the MSCI EAFE index, which is an international stock market index, in gold or yellow. Pick your color, the second bar. And in periods when the dollar has been weaker, like it was in the first set of bars, January 2002 through December of 2008, international stocks outperformed US stocks. But there's been a long stretch from 2011 through September of last year where it was all US all the time. The S&P outperformed international stocks, but more recently, since October of last year, and it's still year to date, international stocks are leading. So with the world economy opening up and the prospect of a weaker dollar, that to us is fertile ground for stock market investors. Let me pivot next to the bond market. There's other opportunities beyond stocks, and one of those is in the high yield bond market. Some people call them junk bonds, but it's been an asset class over time that's given investors a very attractive rate of return. In fact, let's focus on the left-hand side where again, you see the bars. Now, this data goes all the way back to July of 1983. And boy, that covers a lot of ground. That predates my even getting into the business. So we've been through Gulf Wars, we went through the market crash in 87, the tech bubble, we had the pandemic, we had the global financial crisis, and all through it all, junk bonds annualized gave you, if you would have stayed fully invested, of a return on average of 7.69% per year. Now, that's pretty good. But for people who get timid or they say, look, I think I'm smart enough to time this perfectly. Actually, that's the better way of saying it, not timid. But what happens if you miss the best month of every year? That return goes from 7.69% to less than half of that, to 3.5%. And if you really try to make it too cute, you missed the two best months of each year, your return is that third bar, the purple bar, it's less than 1%. So this is about, and I'll say this, just some foreshadowing to my closing slide, which it's about time in the market, not timing the market. And right now, the yield, the worst, or the yield that you could get on the high yield bonds now is at about 8.5%. Just think about that. We would have been jumping over fences to try to get a yield like that. So that to us, we think represents an attractive investment opportunity. Another area is tax-free bonds, especially when we look at how they've rebounded. Last year, there was over $130 billion that went out of tax-free bond funds and ETFs. But you could see the returns on the far left, be it for AAA, which is the highest credit rating bond, they're up 2.5% year to date. Single A rated up 3%. Triple B, which is still what we would deem investment grade in the tax-free bond area, is up 3.71%. So there's still opportunities. And if we look at what's underneath these states and local municipalities' ability to pay principal and interest back in their bonds, they're in a good position to do it, because the middle display is what we call state rainy day fund balances. And as the name implies, that's money that's set aside for a rainy day. It's reserves. It's just kind of safety cash, just in case something crazy happens. We've never seen states and municipalities with this much reserves or rainy day funds. This is a record high. So they're in good shape financially for the most part. There's exceptions, but when we look at it at the national average, it's a very high level. And if we go to the far right-hand side, the blue bars, the blue sections of that is showing Standard & Poor's and Moody's, the number of bonds that have been upgraded by those rating agencies versus those that have had their credit ratings downgraded. We've seen upgrades outstrip downgrades in terms of credit ratings for tax-free bonds for 7 quarters in a row. So you're getting a better yield now. Then the states are in a great position from a standpoint to meet their principal and interest payments. And the after-tax yield on this is quite compelling in a lot of cases. Let me close with this slide. So we've covered a lot of ground. And yes, we have been through some volatility. And near term, we probably will have some more, because the Federal Reserve has raised rates. That takes some time to work its way through the system. Banks are likely to restrain or pull back on some of their lending activity. That has a way of slowing the economy down. That's just part of the cycle. You go through periods of recovery. You go through periods of slower economic growth. We're certainly, we've seen that. We think we're going to go through that, but it doesn't mean that one should give up on their investment plan. Because bear this in mind, that what this chart is showing is something interesting. This is data that goes all the way back to 1988, and it's showing rolling 3 returns. The average 3-year return on the S&P 500 index was 11.1%. If you go all the way back to 1988, that's your average 3-year return if you would have stayed invested. But if you missed the 5 best days, your rolling 3-year returns would have dropped from 11.1% to 3.9%. In fact, that's right in line with what you would get on, say, tax-free bonds with a 5 to 7 year maturity, and that's that last bar that we show as bonds at 3.8. So it comes down to these things. We're gonna have times of turbulence. Again, I've been doing this since 1986. I've seen a lot. Doesn't mean that I've seen it all, but through a lot of the vagaries that we see in the economy, through certain crises that hit over time, the long-term trend in equities has been up. In times are scary. I'm not discounting that. At times, it can give you those moments of momentary pause. But it's incredible to think that the stock market, in a more recent data point, if you go back to the pandemic, it's up over 94% from at that time, and that was indeed a scary time. So just bear this in mind. Always stick to your plan. Don't let the short-term turbulence shake you out of a very well-thought investment plan as you work with your financial advisors at Patelco. So, Carolyn, let me stop there. I think this might be the time, if we still have time, for questions.
Yes, it is. We have some great questions too. And I also received some questions before the webinar. So I'm going to go back and forth. And let's start on slide 6. And what does CS cracks refer to in March? That's from Eve. If you can go back to, I marked it down as slide 6. I believe it was in there. One more, yeah. So what does cracks refer to in March?
Yeah, that's Credit Suisse, the Credit Suisse bank. When that news started to break, they were eventually they had mentioned that some of their some of their loans and their liquid reserves weren't, their access to liquidity wasn't quite what they had thought. And then they eventually received backing from the Swiss Central Bank, and then ultimately they were acquired by UBS, United Bank, Union Bank of Switzerland. So that CS stands for Credit Suisse. So some of the banking concerns weren't just confined to what we saw here in the United States. Some of it had to deal too with, in this case, with Credit Suisse and its access to certain types of liquidity. So there were some tremors over in Europe as well.
Okay. That makes me think of this next question, which is a really good one. What can the Fed do to ensure we don't see additional banks suffer the same fate as Silicon Valley Bank and Signature Bank? Do you see the possibility of this spreading like it did during the financial crisis? Why is it different this time?
Yeah, I think it's different this time because what happened during the financial crisis, but going back to 07 and 08, that was more of a loan quality problem. If we think about some of the things that were going on in the mortgage market, some of the lending, let's just we say, in certain segments of the financial services sector, certain lenders were making things, they were calling them back then ninja loans, no income, no job. So the lending policies were pretty, shall we say, quite liberal to the point where they were in some cases irresponsible. So some loans that were being made shouldn't have been. So the loan quality back then wasn't of the same integrity that we're seeing now. A hard lesson learned, but the lending standards coming out of the financial crisis in 08 went up, very strictly. The difference in this case was in certain cases, banks had bought part of their investment portfolio. They buy U.S. Treasuries, which has the full faith and backing of the U.S. government. But the problem is that a lot of those banks, they had bought some of those bonds with interest rates of about 1% as a part of their bank portfolio. But then you saw the treasury rates on 2 years now are close to 4%, north of 4%. And as we know, when interest rates go up, bond prices go down. That in some cases, some of the banks that had bond portfolios that weren't as well managed, and they had in some instances, people were making a run or were taking deposits out. They didn't have the liquidity that they needed to meet some of that deposit withdrawal. In the case of Silicon Valley Bank, that was a unique circumstance, but that was a $42 billion deposit run on a bank within 24 hours. So we haven't seen that in other institutions. What the Fed has done is they've made credit facilities and credit lines open and available. Other banks have come and effectively said, no, we'll back some of your deposits. They've raised insurance limits to make sure to give people peace of mind. And that largely has calmed things down. So we don't see it spreading to the same extent, Carolyn, that we said in 2008. That said, it's not to say that some banks still won't run into some rocky ground. When you have extraordinary events like this, when the Federal Reserve raises rates so aggressively like that, there's going to be some consequences. And I think what we'll see is some of the smaller banks, especially with regulations coming down the road in light of what happened with some of these institutions, there's going to be more regulatory requirements. You may see some smaller banks say, listen, we can't afford to keep up with these regulations or computers, or computer upgrades, whatever the case may be. There's likely to be some consolidation. In other words, they're going to say, look, we're just going to put ourselves up for sale because we just don't have the economic scale or size to keep up with this. It doesn't mean that they're going to go bust or bankrupt. They're just going to go to some other bank who's going to acquire them.
And it's such a big topic right now, of course, and Patelco Credit Union knows it. That's why we're having a town hall meeting in just a few weeks where actually, I think maybe next week, that our CEO, Aaron Mendez, is going to be hosting and talking about the safety and soundness of Patelco Credit Union. So I would encourage anybody that's a member to attend that webinar as well. So
yeah, Carol, I would just add to that. Yes, I think that's a great idea. And to your point, not all banks are created equal, right? Some of these banks had big depositors that were well over the insurance limits. There's a lot of other banks who aren't exposed like that, and they're in great financial shape.
Okay. Here's a direct question. Are there any risks in putting my money in the money market savings account?
Well, I would say no. Now there's a couple different stripes. Let me make a distinction. There's money market accounts that you could buy that are all backed just by treasury bills or short-term direct obligations of the U.S. government. Those are going to be your safest bet. There's others that invest in commercial paper, et cetera. But even those that are investing in short-term commercial paper is just short-term IOUs between corporations that have a maturity of 1 year or less. So they're very liquid. That market is functioning fine. We haven't seen it. If it was one thing that we learned during the credit crisis of 2008 is you can't let the bond markets effectively freeze up where there's no flow of capital. That's what happened for a few weeks back in 2008. Now that was scary. So what the Fed has learned is, listen, if something hits a system like that, we have to act, and we have to act fast. That's what they did in the case of this recent banking crisis, and the money market funds, the operations in terms of the flow of money have been just fine. So I think one would be okay in any stripe of a money market fund. But if one wants to be doubly sure and what the safest variety, that would be one that is, say, a treasury bill fund or backed by the full faith direct obligations of the U.S. government. So,
okay. There's another one for you. I keep hearing unemployment is low, and that needs to change for inflation to come down meaningfully. Is that true? And do you expect mass layoffs in certain industries?
So it's a component of it. We talked earlier about some of the categories of inflation. If it is the dining out, people in terms of the spending for traveling, recreation services, et cetera. A byproduct of that ultimately is to see the unemployment rate go higher. And we believe that it will. We don't see it spiking, Carolyn, just to be clear. Right now we're still at roughly 3.5% unemployment. We don't see it jumping to say something like 8%, but we could see a scenario that it gradually moves its way up to 4.5, maybe even 5%. So that is part of what the Fed is trying to do, is trying to calm down some and get the labor market back to what they call a state of more normal, steady state. But a byproduct of that tightening is, unfortunately, you're going to start to see unemployment spread beyond the technology sector. We're seeing it in some other services companies. Disney is one example. They've resorted to certain layoffs, so it's going into other industries. And I think you're going to see that continue, but not be anything that's going to explode, like I said, to like an 8 or 9% rate. But that's just unfortunately, that's part of the economic cycle. So it is necessary, and yes, we expect it to continue, but nothing that's going to be runaway unemployment.
Okay. Back on your slide that was, we're not out of the woods yet. What unit of measure was being used?
You have to figure out.
It was more towards the beginning. Yeah. There you go.
Yeah. So what we're saying there is just this, what this is looking at are just the 3-month annualized, and this is in percentage terms. So every one of these lines is just showing you the rolling 3-month annualized rate of inflation is in these different categories. So we take transportation services, that's running on an annualized, over rolling 3 months, that's annualized, still running north of 10%. If you look at recreation services, the second one, it's above 8% inflation. Food away from home, again, 8%. So that's what that's measuring, where the aggregate inflation rate is dropped to more like 5.5 to 6%. These different categories, we'll call them subcategories, when you dig a little deeper beyond just the broad inflation number, if you look at the different segments, these segments are still running hot, and we're measuring that in percentage terms.
Okay. What does that mean for stocks everyone owns? This is back on slide 10, sorry. If you could go to slide 10. What does that mean for stocks everyone owns, like Apple, Amazon, Microsoft? Some people call this FANGs, F-A-A-N-G-S.
Yeah, the FANG acronym stands for the old Facebook, Amazon, Netflix, and Google, now known as Alphabet. And now there have been so many other, it's been an alphabet soup of what I call the usual suspects. A lot of those companies and others like a Microsoft and others that are big, large mega cap companies, as we like to call them. It's going to be case by case. Look, a lot of those companies, yes, they're big, but they don't come with a very high price tag. If we look at someone like a Microsoft, or even someone like an Alphabet / Google, formerly Google, in a lot of cases, we're the view that yes, they're big, but they're trading at a very attractive price. These are companies with very strong balance sheets that generate a lot of cash. So financially, they're in good shape. They still have good growth prospects. But there's going to be some other names that are really big, giant, again, mega cap stocks, as we call them, that maybe we're not going to be so favorably inclined to. It's a case by case situation where this goes back to the old adage: it is a market of stocks, not a stock market. You have to make the distinction in terms of who do you think is best positioned competitively, how well is the company managed, and how much am I paying for it? Right. And you size your position accordingly, meaning that rather than making it 2 or 3% of my portfolio, maybe I make it 4% of my portfolio. We as money managers, that's what we're tasked to do. And we're going to look at these individually and do a comparison. And we're going to go with those that we think are best positioned to win.
Hey, Tony, I'm going to send one your way. And mostly because you're working locally with the financial advisors in our branches. You work fairly closely with the Patelco members too. You meet with them alongside our financial advisors. Outside of cash and cash alternatives, what are you seeing the best opportunities for members to invest?
Yeah, I'd say the best opportunities we're finding is building different municipal bond portfolios for some of the members at Patelco. It is exciting to see, I think, for a lot of members and even bank members of traditional banks as well, to see cash and cash alternatives in the 4 and 5% range as far as the interests are seen. And we haven't seen rates like that in a long time, but in the same respect, we haven't seen rates as high as we are in different, very safe bond investments like municipals as well. In fact, on a muni index right now, you're looking at about a 3.5% tax-free return. And if you add a little bit of credit to that, and Walt went through kind of all the credit worthiness of municipalities right now, states like California, upgrades versus downgrades for a lot of these bonds as well. If you add a little bit of credit and more high yield type credit in municipalities is paying closer to 5.5%. So some sort of a blend there would get you about a 4% yield, which is comparable to maybe what you're seeing in CDs. However, remember that's triple tax-free return that you're getting on those municipalities. And so if you take a taxable equivalent yield of that, you're looking at more of like a 6.5 to 7% return. And with kind of rates across the board, as we do start to see things normalize, as growth kind of starts to come down, inflation gets under control, the Fed's likely to stop raising rates, possibly pause for a while, at some point start cutting them back down to normal rates like we've seen in the past. And so rates across the board, whether it's in CDs, money markets, or even municipalities, will likely be lower if we're having the same conversation 12 or 24 months from now. And so what we don't want to see is folks putting all their eggs in one basket and just relying on those money market or CD returns and miss out on some great opportunities in things like municipals as well.
Okay. Thank you, Tony. Here's one that is back to the banks again, back to some of the failures. I recognize the need for the Fed to support big banks, to support them during a bank run, but what they're doing for SVB is much more substantial than that. Aren't all taxpayers paying the price for their poor management? Is there a better solution than a federal bailout?
Well, in the case of the depositors, that's certainly where the Fed had stepped in terms of making sure that they would be money good on that. Now, as far as the investors in the bank, they were wiped out. So if you're a common stockholder in Silicon Valley Bank, the government was not bailing you out, as in this case as a shareholder, or the bank itself. Actually, the bank went into receivership and was taking at a very low price and acquired by a different banking institution. But the question is a bit valid in the sense that with the imposed regulations on some of these banks, in some cases it's going to be passed through in the form of maybe higher fees for certain banking services. And as I said earlier too, if some of the banks, even despite that, if they try to resort to that, A, it may not be enough. B, they may lose clients who they say, I'm not going to pay so much for a checking account. I'm going to go to a different bank where they're not going to charge me. And that's where, when I alluded to before, some of the very, very small banks are going to be in a position to where they're just not going to be able to compete on a go-forward basis. And then they'll likely put themselves up for sale. Again, in that case, the shareholders aren't going to be taken to zero, anything that extreme, but you're likely to see just less banks going forward. It's not going to happen overnight. It's not as if we're going to go from 3,400 banks as an example to 5 in a year and a half. This is going to take some time, especially if the regulatory environment becomes more stricter as we expect.
Is it true that big banks are quietly loading up on gold?
Some of the central banks have been doing that. So let me make the distinction. So it's not as if JP Morgan, as an example, or Citigroup or Wells Fargo, big banks, are out buying gold. It has been like banks such as the European Central Bank, the Chinese central banking authorities, others like that have loaded up on their gold over the last 2.5 to 3 years. So yeah, there has been added buying on the part of central banks, not just commercial banking institutions.
Mhm. Okay,
And that tends to ebb and flow.
absolutely. Okay. Here's one. It's a good one. I recently inherited a substantial amount of energy company stock. What is your outlook for the energy industry?
So if it's a traditional energy company, say an oil and gas company, if that's what one of your members had inherited, that it and not knowing which company it is, and nor will I ask. I don't want to certainly pry, but energy companies have put themselves in, for the most part, in a much better financial position. Not only have they helped themselves, but they've had some help in the form of a higher commodity price, with oil prices being higher. So consequently, their profits have been on better ground. But a number of them over time have also lowered the amount of debt that they have on their balance sheets. They haven't been producing as much oil. They haven't been investing in, say, oil field exploration and production as much. They've been returning cash to shareholders in the form of share buybacks, dividend increases, because they're in a financial position to do so. With that said, we think that it just energy, not knowing the company, because it's going to be company specific, but that's part of the stock market is one where, yes, there's a number of companies that are very, very healthy. It's not an area that we're favoring in terms. We think there's more compelling opportunities. But if this is a company that does have a strong balance sheet, that is well managed, we still think that the price for oil is going to be stuck in this trading range for a while, at an elevated price than, say, what we saw over the last 10 or 15 years before it started going higher. So the prospects for the complex, the energy complex, we still think look good. And so I just keep my comments to a high level from that perspective. We don't think it's a danger zone, in other words. But knowing the stock, because they're not, again, like banks, they're not all created equal. That would be a discussion that they want to have with their financial advisor.
Absolutely. Yeah. Okay. Hey, Tony, can you flip over to slide 12? I'm going to ask a couple more questions and then we'll wrap this up. But slide 12 on the internationals, there we go. Are there certain geographical areas in the international sector you like better than others, specifically China and Europe?
So we'll build our stock portfolios one stock at a time, but we've seen some interesting opportunities in companies in England, is one country. There have been some based in Europe, Japan as well. So those are some of the regions from the developed economies that we're finding opportunities. Some of the economies in Southeast Asia, companies who are actually selling into China, be they located in places such as Thailand, Vietnam, Korea, or even continental Europe, where in a lot of cases, these are companies that are domiciled. They may be domiciled in one country, but their revenues are far outside or go beyond their stores. So I'd say England, as I said, Europe in certain circumstances, Southeast Asia, Japan, as well as Korea and Vietnam. Those are some of the areas we're finding some fertile ground. And just an interesting statistic. We know Europe is in a kind of a slow growth mode. Unfortunately, the Russia-Ukraine war erupted, and that looks like that's not going to get resolved anytime soon. But keep in mind that of all the companies that are listed on the European Stock Exchange Index, 58% of what they sell is outside of Europe. So think of someone like Louis Vuitton, or Ferrari, right? Or BMW. These are companies that they're located in Europe. More of their sales are Nestle, another classic example, just to name a few. We always look in terms of who they're selling into and what the prospects for growth are.
Okay. Sure are a lot of questions about the banks. I would really encourage every one of you. We're not a bank, we're a credit union. That's very, very different. But I would encourage you to try to get on our town hall meeting, which is, again, I believe next week. I'll try to get the information out to you. We've also had a lot of questions about whether or not this has been recorded. It is being recorded. and we are going to send you a copy of the recording. And I'm hearing from Veronica Dangerfield over here. April 25th is our town hall meeting that you don't want to miss. I think it's, again, it's a very important piece for you. One last question, Walt. Aside from inflation, slow growth, interest rate, bank scares, if that's not enough, what keeps you up at night? Are we missing anything?
I think the main concern that I have is just given, as I said before, with all the Federal Reserve, with what they've raised in terms of interest rates, so as aggressive as they were, because they had to be, they were playing catch up ball, right? They missed that on inflation. They underestimated it, in other words. The main concern of what we're really focused on is just the underlying the profit growth of businesses in an economic slowdown. That's the main thing that we're focused on, because people often say that when the Federal Reserve moves, it works with a lag. So in other words, if they raise or lower interest rates, you don't start seeing the effects for about 12 or 18 months or 2 years, depending on which economist you talk to, which incidentally, I'm not an economist, nor do I play one on television. All that being said is there's been a lot of tightening in the system. As we talked about, the banks, their lending standards became more stricter coming up from 2008, but they're going to be more conservative in their lending in this environment. That's classic behavior. When the economy slows, you don't want to be making loans to people who can't pay them back, right? That's just prudent banking. But what that means is the economy slows, and it consequently profit or earnings growth is going to slow. It doesn't mean it's Armageddon for the stock markets. I'm not implying that, but that's something that we have to always be mindful of as active stock managers, which means we actually select stocks. We're not just buying an index blindly, to try to identify those companies that we think are going to give us that resilient earnings growth consistency. It may not be as strong, but it's not that it's going to evaporate. And we have confidence in the businesses of what we own. But when we look at just where profit growth is going, that's something that the stock market may not take heed to too kindly, which causes some near-term volatility. But I would say that keeps me up at night. That's been keeping me up at night for the 36 years in my career, but it really becomes a little more heightened in a period of an economic slowdown. So that's where we have our focus train right now.
Mm-hmm. Okay. You know, there's so many good questions. We're not able to get to all of them tonight. I apologize. As Walt and Tony mentioned throughout the presentation, most people need advice. And so we have 11 financial advisors. Tony, can you flip towards, keep going out to right there. Okay, so we have 11 financial advisors that can help you make those decisions. They can help you with tax-free income, retirement planning, retirement income, 401k, and IRA rollovers, financial planning, life insurance, long-term care, and wealth transfer. And also they're available to meet with you the way you want to do business, in person or over the phone or by Zoom. And by the way, our financial advisors have an encrypted version of Zoom for your online protection. And we're going to drop a link. Veronica, thank you. She dropped a link in the chat to help you locate the financial advisor that's assigned to your local branch. And, or you can just contact me directly. There's my phone number, my email address, and we will get you to the financial advisor in your area. If you contact me directly, please let me know what branch is most convenient for you. And we'll get you there. Now let's talk about the promotion. And it's simple. Through May 31st, you can get a $100 Amazon e-card when you invest $25,000 or more with us. So click on those links in chat to get an appointment scheduled. And one last slide here, that our next investment webinar will be on May 24th. And it's Understanding Social Security. If you want to attend that, we have not advertised it yet, but please take a photo of the QR code on the screen to register. And then lastly, on behalf of Walt, Tony, Veronica, and myself, the entire Patelco team, we thank you for attending tonight's webinar. Please check our website and join us for future webinars. And remember, wherever you are in your financial journey, Patelco is here for you. Thank you very much and good night.